Welcome to tonight's Pension Fund Committee meeting. My name is Councillor Ross Melton, Chair of this committee. A couple of housekeeping points before we begin. Please can I ask officers to introduce themselves before speaking for the first time? I think it's a courtesy as well for the members and any of our guests to do the same. When speaking, please ensure that you are close to the microphone and speaking directly into it, which is advice I am not taking. This meeting is being live streamed on YouTube. By taking part, you are consenting to be recorded. If the fire alarm sounds, please leave by the nearest exit and take instructions from security officers who will make themselves known. Fire exits are located via the double doors to the front of the meeting room, via the car park, and the main door into the clockwork reception, or the door at the rear of the ground floor beside the toilets. The assembly point is located outside St. Peter's School, which is front of the building. Toilets are located in the clockwork reception area. Security will assist in directing to you. Excellent. Let's proceed. So first, apologies for absence. Councillor James will be joining us shortly. I've received no further apologies. Declarations of interest. Can I ask if any members have any declarations of interest?
I may have one related to the item on the agenda where we discuss defence company stocks, in that a number of the companies in question are clients of mine and my team in my day job.
Excellent. We'll take advice from officials about whether to mitigate that. Perfect. Thank you very much. Then item 3, minutes of our previous meeting. Can I ask if members approve the minutes?
Agreed.
Seconder? Thank you. Excellent. Moving on to item 4, Aviva Investors. Please, Phil, will you introduce this item?
Thank you, Chair. So we're pleased to welcome our friends from Aviva tonight who've kindly agreed to attend. In terms of the background to the current scenario, the fund did receive its final liquidation payments, and we are all square on that front. We've also heard from Aviva in the last few days concerning a refund of the management fee that applies from 1st of January this current year, 2024, to date, and that money has been received in the pension fund's bank account, which was paid yesterday, I believe. So Aviva have kindly agreed to attend. Really, it's just in terms of the committee members being satisfied that everything that has been done could have been done with regard to the lateness of the payment and the fact that the fund loss net of income receivable from the 1st of January this year, the net loss is around £2.5 million. And that arises purely from the fall in the market value from 31st of December last year to date of the date that the funds were received. So I'm very happy to, with your permission, Chair, hand over to Aviva for their presentation.
Hi, just briefly, my name is Dave Sapsford. I came along last time. I'm the Client Relationship Manager at Aviva Investors for London Borough of Hammersmith and Fulham. Tonight I'd like to introduce Jill Barber, who heads up our distribution department, and Danny McHugh, our Chief Investment Officer, both who sit on the Aviva Investors exec. And Jill, if I could hand over to you.
Yeah. Thank you for the opportunity, Chair and councillors and members, to come to speak to you this evening. I did want to acknowledge, as I think Mark Varsey, our CEO, did when he was here in June or July time, forgive me, I forget, I think it was July, that we recognise communication could have been better, and we acknowledge that, and I'd like to apologise for that. Phil, as you've also just provided information to the committee, we did honour in full the repayment that we promised that we would do. In fact, we extended it to the full year rather than for 6 months. So you received that yesterday. And I just wanted to reiterate our apologies again, and we're very happy to take any questions that you may may have.
Thank you. First question. Do you accept our officer's analysis that our fund has received a net loss of £2.5 million?
Danny, do you want to?
Yeah. So the figure that's been used in terms of the loss, effectively, the net asset value of the fund will vary from time to time, as you would expect. The aim is that the net asset value of the fund will appreciate over time. And certainly from a private markets perspective and for infrastructure assets, really for the last 10 years up until 2023, capital values had been increasing, particularly in a low interest rate environment. 2023, as we experienced a move towards an increase in interest rate environment, impacts all assets, but in particular capital values of private markets that are directly correlated to interest rates. So what we've seen is this dramatic repricing of interest rates that then creates a negative impact on private market values, in particular infrastructure assets, but other assets in a similar vein, and suppresses the capital value. When the figure was provided in terms of an estimate of what the redemption amount would be, it was based on a net asset value that was calculated at that date. It wasn't a guaranteed price, because the price is calculated at the point where effectively the redemption is made. The obligations on the fund post receiving the redemptions is to take reasonable endeavours in which to create funds and liquidate assets to make the redemption. Now, as is normal in illiquid assets like private markets and like infrastructure, it takes a period of time, months, sometimes longer, in which to market those assets in a structured way to get the best price in the market for those assets, and go through the process of contracting and effectively disposing of those assets, i.e. you can't press a button. So you're then susceptible to price movements in that period of time, market movements in that period of time. And in 2023, we've seen significant price movements in the market, where investment volumes across private markets reduced by at least 50% based on previous years. And that was really driven by the lack of uncertainty in terms of the macro environment, but also an increase in interest rate environment, which caused a lot of investors to withdraw from the market. So I think in terms of the loss, the figure that's been measured against was an estimated figure at a point in time, unrelated to the ability of the fund to effectively create the cash proceeds to meet the redemption. And for all investors, obviously, the proportion in which their interest in the fund is calculated, it's based on the net asset value at that point in time, as opposed to at a fixed period at a preceding date.
So when we're explaining to our fund members, when they ask for us to explain to them why we've lost £2.5 million on this particular investment, we would be correct in explaining to them that that is a direct result of 2 years of delay in redemption. Would that be correct?
So you're explaining a loss based on an estimated figure, not an actual figure, is the point I'm making to you.
Chair, I just need to clarify that. We've taken advice from our ISIO consultants on this one. We had a market value as of 31st of December 23. So that's definitive market value. And that £2.5 million net loss is nothing to do with any events in 2023. We had a valuation 31st of December 23. So if funds had been received at that point in time, we would have had £2.5 million more. So there's nothing estimated about that market valuation at 31st of December 23. So this £2.5 million loss arises from the delay from 1st of January to the date in September, when we finally received the final payment through, that's how the loss is calculated.
The valuation of private markets is based on an estimated net asset value. It's not realisable because you cannot press a button and realise the cash tomorrow.
But if we'd received our funds at 31st of December, it would have been on that value.
If there was cash in order to make those payments, but it's based on an estimated value, not a realisable value.
That's the whole point, that nothing was done sufficiently to generate those sales by the stipulated date, which is this is the whole argument, that you had 18 months in which to create these sales in order for us to receive the agreed amount on 31st December 23. So if those sales had been made in time, that's the market value which we would have been applied to our payment, and that's the amount we would have received.
So the point I'm making in terms of the trust documentation, after receipt of the redemption notices, there is an obligation under clause 26.1.2 of the trust documentation to take reasonable endeavours to realise capital in the next financial calendar year in order to meet those redemptions. That's what we then sought to do in a very, very diligent and professional manner. So we sought to meet those redemptions in line with the documentation. However, in 2023, we were in a market environment which was extreme relative to the preceding 10, even 15 years, where we've seen a dramatic reduction in transaction volumes in that market environment, which meant it was more difficult to attract buyers to buy these assets, and the time periods attaching to transacting against those assets was taking much, much longer than a normal market environment would take. All the way through that process, we are diligently seeking to optimise the value for the investors in the fund and realise the maximum proceeds back for investors.
So, Chair, I think what I've said counts, and the fact that there were no assets to sell by 31st of December, no proceeds generated. So really the crux of the argument is to why there was that delay that applied for 9 months into 2024.
Is it clear from my explanation of the market environment is that
what we've asked you is to explain not the challenging market conditions, not that you had difficulty reaching selling these assets. What we're asking is whether you accept that the reason we have received a loss is not external market conditions, but is because of your failure to sell assets in a timely way and to provide a redemption within the sort of not prescribed but target timetable set out within our contract with the Boots.
sorry, for me, we have executed in terms of the ability to raise the capital and the proceeds in a very diligent and a very professional manner in the way that anybody else in the market would have done so. So for me, we have been absolutely diligent. We've also done it in line with the documentation. There is no target. There is an obligation in the documentation, which we have adhered to, and obviously sought to optimise where possible. The loss that you're referring to is based on an estimated number at a point in time. It's not an actual proceed that the fund was capable of delivering back to investors, because, and your advisors can give you advice on this, every private market valuation is on an estimated market valuable, realisable proceeds. But until such time as you take that asset to market, until such time as you have investors who are prepared to buy that asset from you, and there is a passage of time. In some situations, that passage of time can lead to an appreciation in value as opposed to a depreciation in value. So the numbers can go both ways. It's based on an estimated opinion of market value.
Mike Adam, I'm a co-opted member of the committee. Is the timing of this additional markdown, if I'm understanding it correctly, because based on what Mr. Triggs has said, there was a valuation at the end of December 2023, and then there must have been a subsequent markdown in 2024. Now, I can understand why there was a big shift in market pricing on the back of the gilts crisis at the end of 2022. But what has happened in the course of 2024 that's caused a further write-down?
So through 2023, the valuation in the fund moved negative for that period of 15%. Combination of factors, as I said to you, in terms of the risk-free rate or interest rate that impacts all values, but then it becomes specific to certain assets, etc. Just to bring a bit of perspective to that, if you look at other private market assets like real estate, commercial real estate, at the start of 2023, commercial real estate seen the biggest significant capital value drop that it had seen in history, where capital markets repriced by, certainly in the UK, approximately 30% in the space of one single quarter. And that was driven primarily by interest rate movements, where effectively the cost of borrowing money to buy an asset exceeded the income that that asset would actually pay to you. So I think in these circumstances, although any kind of reduction in capital value is not something you want to see and you invest for, I think what we've seen in other areas of the market, and we would have seen even in infrastructure assets for specific reasons, the capital value movement could be even more extreme.
Yeah, but surely you would have marked it down after the gilts crisis in 2022 or in the course of 2023. So I'm wondering, why has it deteriorated again in 2024?
Well, it could well be, and I don't have I've got the detail of the capital value reductions here in front of me at a fund level. I don't have the detail of every specific asset, but you can see variances that will occur specific to an asset. For example, certain assets could fall out of favour with investors, where there's less appetite for those assets for various different reasons. So, for example, what we've seen at the end of 2023 was a reduction in values related to wind assets, where wind assets effectively have a forward forecast on how windy it will be, believe it or not, on a 5-year basis on a forward look. Those estimates are refreshed on a regular frequency. When those estimates are refreshed, it sometimes can impact the value on a positive basis or a negative basis. So that's just one example. There's a number of factors that go into the valuation methodology, as well as simply interest rates, and they're very specific factors to that asset or that type of asset.
Chair, just to clarify, the only time period that we're interested in is the time that elapsed between 31st of December 23 and September 24 when we received the payment. What happened in 2023 is completely relevant because we were concerned with the valuation at 31st of December 23, which is when we should have received the payment. So events of 23, which resulted in whatever decline in market value that took place at that time, up to 31st of December 23 is irrelevant. We're just interested in the valuation at 31st of December 23 and then the delay of 9 months subsequent to that. So I'm not sure why the events of 2023 have relevance here.
Well, they have relevance because I'm being asked the question in terms of the differential between the two numbers. But
the only differential that we're interested in is between 31st of December 23 and September 24.
Yeah, and that's 15%.
Sorry, you'll have picked up there's a lot of anger in the room about the performance of the fund and the delay. I think part of that anger is that continually the message that we were receiving from Aviva well, for a start, there wasn't a proper communication about why the payment was going to be late. But then from then on, the message I think that we kept receiving was that there was no impairment to the assets that were about to be sold, and that you had an offer on the table and it was a reasonable offer. And then it now appears that the actual cash that you received for that was less than the valuation, excuse me, the valuation at the end of the year. But we had people sitting in front of us saying that they were confident that the valuation was reasonable and that that was what was going to be received by the buyer. And I think that's the anger you're picking up, and a degree of complacency as well. You know, at the last meeting, when you were actually here, you know, we asked simple questions around, you know, the timing of those sales and the method, and you know, we were told that various NHS trusts had to sign things off, and no one had even asked, because it was a meeting in July. Nobody has board meetings in August, and we were still being told we'd get payments in September. And just from a practical perspective, I said it just wouldn't happen. But we just kept hearing that complacency, and I think that's what you're picking up.
Yeah.
So the lack of communication and the complacency about the valuations were good, and clearly there was a difference. So.
Yeah, so I, you know, I apologise for that, because, you know, for me, there's absolutely no reason to sort of provide information that's sort of misinformation. You know, I think going back to what I said previously, and, you know, I used to do this. I used to transact these assets on a regular basis on both sides of the equation, selling them and buying them. And they are complicated transactions. And I think, as you probably know, inevitably they're negotiations as well. So, you know, to be able to sit and say, you know, 100% that will be the figure that's delivered until the sort of it's signed, sealed and delivered, it's very difficult. You can say within a reasonable view, you've gone through periods of due diligence, you know, the buyer's at a certain point in terms of contractual obligations, and your confidence level increases. At the same time, you know, I'm sure the opinions that were expressed relative to the valuation and things were known at that point in time. But absolutely, in, you know, going back to the point I was trying to make, for me, 100% motivation, I accept the communication point. It should always be better, and it shouldn't be in that situation. But 100% the motivation that we have had here is to maximise the proceeds back to the investors in the fund. There is absolutely nothing in our interest to do otherwise. And, you know, I'm confident of that. But I appreciate, you know, the timing aspects of that can be extremely frustrating for people, especially if they've been told something different, or they haven't been given full information of the market context or the counterparty context in a particular transaction, which it sounds like, you know, you had actually previously identified.
Thank you, and apologies to colleagues for coming in slightly late. I think the clear implication from the responses that we heard in July were very different from how you began today by saying that the communication could have been better. As we've just heard, you've just accepted we were provided with misinformation. That's really very serious. I would like you to revise your analysis and what you're saying about communication could have been better. You just repeated that phrase again to us. I think misinformation is goes much further than could have been better.
So, thank you for your comment, Councillor. If I may politely just ask around, I don't think Danny's provided sort of misinformation. We were saying at the time the information could have been clearer, but we certainly have worked in the best interests of all investors of the fund. I recognise and appreciate that we could have communicated more clearly to you, but the information that was provided at the time was not misinformation.
I think you literally just said it sounded like misinformation. It certainly felt like misinformation to us. We were here in July. There was information in July, 6 months on from the valuation in December prior to that, where we could have been told an awful lot more information than we were given. We were not given information that we were entitled to. So I think it is a far cry from could have been better. And I invite you once more to revise that analysis.
I absolutely accept that we could have been clear in our communication, but I don't believe it was misinformation. The information we provided at the time was the information that we had, as Danny has highlighted. These transactions are very complex, and we provided information at the time with the full intention that we would be able to pay the redemption payments in time for you. But I think that's more what you were saying, is at the time the information that we had, rather than it was misinformation. Yeah.
So in July, we were talking about the sale of energy centre assets that was going to raise the cash to pay the redemptions monies. The contracts with the buyers of those assets were in place and they were set. There was a extra dependency on there that didn't impact the price or the deal or what have you, where the NHS trusts of each of the energy centres had also give consent before the transaction would complete and the money would flow back to the fund. So that was where the delays came with those NHS consents coming through. Originally, we were hoping a group of them would come together. That would give us enough cash to pay back the redemptions to the council. Those NHS sign-offs started dripping in one by one and took longer than we expected. But the actual deal underlying it all was in place and completed as expected, just delayed with the NHS consents.
I'm really sorry. I don't think anything that you're saying now deals with the point that your approach to us in terms of how you communicated with us was a far cry from could have been better. It was really severely lacking. Okay, whether or not we called about misinformation or not, and I think there has personally been misinformation or not full information that we were entitled to, it is a far cry from could have been better. It was seriously lacking, and I would like you to accept that it was beyond could have been better.
I do accept that it was lacking, absolutely.
Thank you very much, and thank you for coming. I fully support all the points that have been made earlier, and particularly that point about communications. I thought at one point earlier on you were apologising for misleading us, and communications, you don't seem to have clarified that sufficiently. Are you not concerned about your reputation? And aren't you concerned about professional? You keep using that word. One of your colleagues has used that word many times about professional. We don't feel that you have been professional. And there have been some things, we raised it, I did actually raise it when you came to a meeting a couple of times ago about some reputational damage that had been done to some of your investments, I think in the Far East, in India, and there's been stuff in the national press about Aviva, literally in the last week. We are accountable to our members. £2.5 million is a lot of money, a lot of money. I thought maybe you were coming tonight to address that issue and maybe to say to us, well, you've had a rethink and you're going to address that difference, because there's no reason whatsoever other than you just delaying and delaying and delaying till the market circumstances were better for you, for the reasons that you've given tonight for paying us late. So I'm very disappointed indeed. And I'll just go back to this point. Reputation is key in any business, any business. at any organisation. And your reputation is at a very low ebb in this group. Thank you.
I'd maybe just come back to the NAV point. So I'd agree with a lot of the comments that have been here. I think so the markdown in the asset value is driven by the net asset value of the fund. I think there is some truth to say that it's an estimate, but the reality is private market funds, so Aviva and others, employ third parties to get accurate estimates to say, based on market conditions, based on transaction volumes, this is what we think these assets and these portfolios could sell at. And I think there's an element that should be accurate, and if it's not accurate and done by a relevant third party, then there's an issue there. I think the question on interest rates again is there's some validity there. So interest rates are really strongly in short and sharp in 22, and that fed through into private markets in 2023, and that decreased transaction volumes, reduced values. But if the independent values are doing their job properly, which I would expect them to do because they're independent, that should have fed through 23. So I think that probably brings us back to the question of the key question is the net asset value in December 23 to September 24 has declined by 15%. And I'm not entirely clear why that is. It must be asset specific reasons. So it'd be good to understand that a little bit better, I think.
So, sorry, the decline in value is through 2023. The redemption was received in mid-2022. Yeah. So you just...
So I think the reason given was that the spike in interest rates caused the decline of value in 23, but then there's been a further decline from December 23 to September 24. So it feels like the impact from interest rates is separate to that. So it'd be good to understand in a bit more clarity of over that period to 23 to 24 why the assets declined a further 15%.
Yeah. So that is a very detailed question I don't have in front of me, but as I alluded to previously, there will be very specific asset related points, which, we can follow up offline. The transparency in that would have been given through quarterly reporting information, etc. And it's something that we'd be more than happy to share. It's not something that wouldn't normally be shared with investors, but I just don't have all that information in front of me.
Please do share that analysis. Marion.
If it's all right, may I suggest that my proposal, which I'll put in a second, is probably the last thing, because otherwise I feel we're going round in circles here and the really important things. But if you could go back to the office, please, and come back with a written response to Phil, because while you've been talking, I looked at the returns for your fund that were reported in the quarterly reports. For Q1 this year, it's 2.7% fund return, not relative, and for Q2 minus 4.3. So then we're saying that the actual, my understanding from this conversation is the actual total return for the year to date is minus 15%, which those two quarterly numbers don't go anywhere near, which is why I'm saying earlier that we continually heard assurances that things were all right, and obviously something has happened. So I've just pulled those out. They may not be incorrect. You may come back and say they're wrong, but I think we're not going to solve this here. So could you go away and give a written analysis, please, to Phil, and he can circulate it to the committee?
Absolutely.
Is that reasonable?
Thank you very much for joining us.
Thank you.
Apologies if I overstepped the mark there.
Not in the least, Marion. I very much agree and am grateful to your suggestion. I agree that there's a risk of us retreading the same ground again. I remain, and I'd like it to be minuted, dissatisfied with the lack of explanation to very clear questions, and I find it very surprising that a fund manager would join us when there's only one question, and they would say very clearly, repeatedly, that they did not have the information to be able to answer that one question. Thank you, Amrita. Of course, Mike.
I think what was unsaid was the possibility that the fact that the fund is known to be a forced seller has impacted on the receipts that they've got. And remembering that we put in our redemption request before the gilts crisis because we'd already lost confidence in their management, I just find it strange that twice now we've had senior management come and they've not even addressed the point as to why we put in the redemption request in the first place. So it just shows a complete lack of awareness as to why we're so upset about this. And it's not just what's happened since we put in the redemption request, it's why we put in the redemption request. Because I don't think every fund in the market has experienced the same troubles that they have.
Right, let's tie that one off. Happy to move on. Thank you. Okay, moving on to rather more positive news with item 5. Eleanor, if you wouldn't mind introducing the key performance indicators.
Thank you, Chair. Good evening, everyone. So this first paper sets out the key performance indicators for the pension administration service provided by LPPA for the period Q2, that is July to September 2024. So LPPA processed more cases, so 117 more cases than in Q1, and all KPIs, so all case types were processed on or above the 95% target. So the key improvements were those seen in retirements and bereavements, which are, as we all know, the most sensitive cases and often the most complex and have taken the longest time to achieve target on, but it's a positive sweep across all case types. And I welcome any questions on that performance.
A very positive result, Eleanor, and a real ringing endorsement of your team and your own work liaising with LPPA. Any questions? Thank you.
Thank you, Chair, and thank you, Eleanor, as usual. And yes, I second what's been said. We're all thankful for your team and your hard work. At last meeting, when I asked the question about how much support you're still giving the LPPA in order for things to reach those levels, you said to us that there was still some work, you were still having to do some work to escalate, to resolve some cases. You said that even though they were significantly less than previously, there were still some cases, and that normally you would lend some support, but maybe not to the level that was at the last committee. So I was wondering, in order for us to understand the true cost of LPPA, could you tell us whether that has changed since the last time we spoke?
Thank you, Councillor. It hasn't changed, unfortunately. We've had a couple of key cases this period that have escalated. I want to touch on some examples in my next paper, but certainly we are still having to intervene and suggest solutions to LPPA where they've fallen down in their processes. There are unusual cases and they're not on the main, but unfortunately, yes, we are still supporting them, so they're not there yet in terms of quality.
Thank you, Eleanor, and thank you, Chair. And yes, I'll listen to the examples and maybe we can discuss them at the next item. But I think what I would want to raise to the committee is that therefore we may not be hitting the targets in truth, because if you're lending some support, that means the LPPA aren't getting there on their own. And there's therefore a cost to your team working on this and other things that you would normally work on. and that means we're doing their job in part, and that's funded by us. So I don't know how we can assess that properly, but in reality, let's say that if you've helped them with 3 retirement cases this month, but in front of us we have a report that says 97%, I don't know the exact figure, then it's not 97%. So the RPPA reporting is, and I think that's something I'm trying to make a running theme of these committees, is I think we have flawed numbers before us, not because of you or the RPPA intentionally, but actually if you subtracted all the support you give, would we still hit the SLAs?
Thank you, Councillor, and very valid points, which I agree with. I think where we would see that transpire and into qualitative data is in the member satisfaction scores, which are in those key areas of retirements and bereavements. So when we start to see more surveys returned, and overall they are actually well above, I think 67% is the general satisfaction rate. But when we start to see more of those responses come through, and of those more responses, most of them are positive, then we will know that they are getting better and that the service is improving and the quality is improving. So I think the next thing to watch is that satisfaction piece, which they are doing some work on. They have liaised with their own peers in the pension administration sphere to benchmark themselves. They are above average. They're not the best, they're not the worst. But they are very committed to improving themselves, not just as a tick box, but in terms of providing the best service they can to all of their clients.
Can I ask members to note the report? Noted. Excellent. And then now, Eleanor, staying with you, we can accelerate towards some of those case studies.
Thank you, Chair. So the second paper sets out the summary of activity in the pensions administration operations of the Hammersmith and Fulham Pension Fund, including legislative activity notable for the fund. So employer engagement continues to be good. So in respect of monthly return submissions, so they're well above the average for both the industry and of all their other clients. So LBHF are actually on top of that leaderboard. We have seen a falling number of help desk inquiries, but contradictory, an increase in the average wait time slightly and the abandonment rate. On the regulatory side, the fund is preparing to present the general code compliance. So a future paper to the committee will be presented on the fund's compliance to that. There is a consultation noting on the inheritance tax changes, proposed changes that LPPA will also be commenting on themselves and sharing that with us. LPPA continue to upgrade the McLeod software on their system. We did now overall, that shouldn't have an impact on the processing time of retirements, but we have had one case that was continually escalated internally at LBHF that did have an impacted on the lead time, and an individual did have to wait longer in order to receive their payment. Investigation showed that was because they hadn't had a case that was like that, where there were a number of factors involved, so long service, flexible retirement, McLeod implications. But going forward, they are confident that it won't impact on SLAs. I think the key thing there, though, is not necessarily negative. It means they were taking the time to understand the implications of all of those different factors for that particular case. And in terms of managing members' expectations, part of that comes internally. And my team, we've done some work on, and are doing some work with HR to manage people's expectations in regard to that retirement process. So the McLeod aspect, they're very clear on what the implications are, but LPPA's UPM system has had continuous updates because the LGA has provided some clarification, which has changed several times. And so when it changes, they reassess everybody. So that can lead to some more work done, but it shouldn't impact on lead times. But we are watching that because of that particular escalated case. In terms of the dashboard, they're on track to meet the readiness and continue to meet with their clients. So they've had one dashboard seminar and they're having another one next month. I welcome any more questions from the committee on those subjects.
Is now a good time to discuss the impact on pension fund administration of the reforms announced by the Chancellor at Mansion House?
Thank you, Councillor. We are. There isn't clarity on pension fund administration. It's very much more muted on the funding side. So I'll leave Treasury and Investment to comment on that. But on administration, there is no clarity or implication other than in terms of the consultation, in terms of the impact on. I think it's proposed that administrators will have to calculate the tax liability and make sure that that is taken from any death grant payments prior to paying that out to the beneficiaries. But in terms of the implications for the wider piece, that there isn't any clarity or comment on that we need to be aware of. It's something to watch for the future.
Chair, I concur with Eleanor's summary there. In terms of the amalgamation of funds, we were expecting the possibility of fund mergers, and that was especially the case with London, given there's 32 London boroughs, and most of those funds are valued between 1 billion and 2 billion. So there was room for some form of merger possibility. And the favourite outcome of that was possibly 32 funds to come down to 4. And it's widely accepted in the industry that to merge funds is an awful lot of work. So you've had 2 in the last 5 years. One of those has been Northumberland merged with Tyne and Wear, and the other one was Wandsworth merging with Richmond. Both took 3 years to get the Act through Parliament, to combine payroll administration software, and to get the thing up and running is huge risk to paying pensions on time. So what we saw from the Chancellor's speech and then the consultation document was that is being shelved. There are no fund mergers, so we won't be having to merge administration processes.
Major relief.
And I'm certain a topic we will return to. Any further questions on pensions administration? Can I ask members to note the report?
Noted.
Thank you very much, and thank you very much for the updates, Eleanor. Pressing on then to item 7, can I ask Phil and Sian to introduce the draft annual report?
Thank you, Chair. Sian Cogley, Pension Fund Manager. So the Pension Fund Annual Report for 2023-24 includes the draft pension fund accounts. It's a regulatory requirement and is required to be approved by the Pension Fund Committee. The draft annual report is attached as Appendix 1. Members are asked to comment on any matters in the draft Pension Fund Annual Report and delegate final approval to the Chair in consultation with Triborough Treasury and Pensions Director, Phil.
Can I have any questions?
Thank you very much. 3 very, very small comments. On page 72 onwards, lots of investment is set out. And I know that there are numbers on page 80 which set out UK-specific investments. It might be useful to have overall investments as a percentage of UK assets, especially given where government is at the moment. On page 84, there is an interesting graph setting out admin costs. That does show admin costs continuing to rise, and I think it would be useful to have a couple of explanatory paragraphs in there setting out what action is taken to sort of get that per person cost. And finally, on or around page 55, I think it would be great to have some recognition of also the work done by co-opted members on the committee.
Feedback gratefully received. Eleanor and I have already got a meeting booked in January to work more collaboratively on the annual report going forward to flesh out some of those concerns.
Fabulous, and certainly echo our gratitude to our co-opted members. Any further questions? Fabulous. Can I ask members to, yeah, please, Laura.
Just my name is wrong. So just on page 54. It's Laura, not Lauren. Thank you.
If there are no further corrections and queries, can I ask committee members to approve the draft annual report? Fantastic. Excellent. And to delegate approval to both Phil and myself. Fabulous. Pressing on then to item 8, remaining with you, Phil and Sian, for the valuation.
Thank you, Chair. The Section 13 of the Public Service Pension Schemes Act 2013 appoints the Government Actuaries Department, or GAD, to analyse triennial actuarial valuations of the LGPS. In their report, the Hammersmith Pension Fund received green flags across the board on GAD's various different tests, reflecting the fund is in a strong position with a funding level of 110%. If we can now take any questions on this item.
And again, a further valedictory endorsement of the pensions investment team. Can I take any questions? Wow, violent agreement in the committee room today.
Chair, just to clarify, that 110% is the GAD moving to a level playing field for all of the 86 pension funds in the LGPS. So putting all the assumptions even, Stephen, all the way through. So Hammersmith and Fulham compares quite well with the industry. It's probably one of, in terms of 60% maybe that are in surplus. And the actual actuarial funding level that was calculated by the actuary with Hammersmith and Fulham's own assumptions was 105%. So this points to that actuarial process being very prudent. The GAD has taken it with a slight relaxation overall in the assumptions and moved it up to 110%.
Exceptional. Someone should almost give this fund an award. Any further questions or observations? Can I ask members to note the Section 13 valuation?
Noted.
Thank you. Pressing on to item 9, and I'm very pleased that we've been able to bring this forward following a question from a member of the public. Staying with you and Sian on defence company stocks.
Okay, will do. So thank you, Chair. This paper is a detailed study of the current exposure to various stocks associated with defence and arms and munitions. So that is set out within part 2 of the report, and you can see those stocks listed individually and amounting to some 3.5% of the total portfolio. Mostly they're under pooled management in terms that they are part of a index tracker fund where that particular stock has a place in the index. So therefore our exposure is automatic by being a member or by buying an investor in that particular index portfolio. So it does make it a huge challenge. If we wanted to remove that exposure, we'd have to look to a different type of index without such exposure, which is a challenge. Section 3 sets out the fund's or the committee's fiduciary duty to act in the best interests of pension scheme beneficiaries. We also have the Supreme Court ruling set out in part 4 with regard to the Supreme Court's view on a pension fund committee's approach to its duties. And then I think one of the most important aspects is the opinion that's set out in 4.6 onwards, where Nigel Giffin, who's the most renowned LGPS King's Counsel in the country, has set out his views with regard to International Criminal Court and where the fund stands in relation to those particular points. So his view is set out between 4.6 and 4.12. So really, this is a discussion paper, Chair. We've set out in full the information that's required, and it's for the committee to react accordingly. Thank you.
And thank you for officers for preparing such a comprehensive and enlightening analysis. To underline a few points, that this is a relatively small investment for the fund, and that the majority of this small investment is remote through pooled assets that we have influence but limited control over. I would also make the point that as the UK emerges into a more challenging international climate, that the ethics around investment in defence is changing and is something that we as a committee should take a responsible view over and continually observe and review. I hope I invite any further observations or questions.
I think I just want to reiterate the point I think I made at the last meeting about making sure we take some time to look at our ethical investment principles, and that really is a priority in my view, and something that needs to be brought forward.
I think it's a point very well made, Laura, and something that we should be prioritising in the coming quarter. Exceptional.
Phil, Sean, if I missed it in the report, but what's the threshold for including the names on the list? Because some of them, just looking at them at random, like Microsoft or Bayer or AT&T, you wouldn't think about them as being primarily defence. But did you say, well, more than say 5% of the revenues have to be defence related, or what was the threshold that you?
I think I can answer that on behalf of officers that these were companies that were identified by a member of the public who's very very kindly joined us today as companies that have an involvement in a particular conflict. Is that correct? Not really, but well. Are there any further member queries? And then I'll take the unusual step of inviting a member of the public to join us. Please.
Thank you. I'm not sure that's sitting behind the sign. My name is David Wilkins. I'm a resident of Hammersmith and Fulham, a director of Hammersmith and Fulham Community Energy, and I raised this question with the chair earlier this year. There are a number of councils in London dealing with this. It's being discussed in Kensington and Ealing. Waltham Forest have said that they are taking 773,000 out of its 1.1 billion pension fund. Anything to do with arms, anything to do with companies that are involved with arms. So you may find yourself as something of an outlier as time goes forward. And I think that may not be a good position for the council to be in. What I really wanted to say was that I understand the arguments about pooled funds. One of the pooled funds in the report that was produced makes it clear that there shouldn't be investments in a whole range of things, including gambling, alcohol, the normal set of things. So that's easy. Another one of the pooled funds specifies that into cluster munitions. So something very specific. So The argument that you're in pooled funds and you just have to do what they say is not actually accurate. I think even within the pooled funds, you could move money from one pooled fund to another and jump out of funding companies that are in any way involved in arms. Just one last thing, and the answer to your question is that this came about perhaps from the situation in Gaza because of Elbit Systems, which is one of the companies that appears on the list. Elbit Systems, it may be an attractive time to be investing in arms companies. Elbit Systems have just lost a £2 billion contract with the Ministry of Defence. So I can't imagine that it's much more complicated than it may seem at first. But I think the issue is not simply a financial one, and I understand your responsibilities to the members of the fund. It's a moral one, and I think it would be a good. My question then, that was a ramble. So my question is, will Hammersmith and Fulham Pension Fund take a moral stand on this and at least say for the time being that they're planning to move all investments out of companies that have any connection to arms?
David, we're not going to make that commitment this evening. I think Councillor James makes the appropriate point that this should be debated and discussed within the committee as a potential priority for us within our investment principles, and we've committed to doing that.
Thank you very much, and thank you for allowing discussion on a very important thing.
Please.
Just before you go, sorry, we regularly raise, as Councillor James said, the issue of ethics. We raised it at our last meeting. I spoke about it and others did too. So we are keeping everything under review as we move forward, and we're not complacent at all about the wider geopolitical events that are going on. And we ask our advisors about that on a regular basis. So it's not that we're not as concerned as perhaps residents also are, and you yourself are, but we obviously have an obligation, and some of these investment funds are invested in over a long period of time, but our ethics is key to all of us in this room.
Thank you. Good to know. Well, I don't doubt that. Sorry.
Thank you, David. Marion, did I see you wanted to make a contribution? No? No. Can I ask members to note the report? Oh, sorry, did you? Sorry, pause that. Prior to that, Florian, please.
Thank you, Chair. Yeah, I mean, I'm very thankful to you for coming to challenge us on that. I think it is really important, and for this space to be a space that feels free for us to express our views. My own personal views is that yes, if some of our investments are also used to help the people of Ukraine defend themselves in their invasion, and that's a good investment too. And I think it does benefit our people in our country, and some of the people who live here are Ukrainian people. So it's about how perhaps, and we've raised this in this committee, we can improve the scrutiny of what goes on in those pools, and because there's that sort of middle person between ourselves and the actual thing. So please do come back again or write to us with ideas. But yeah, just to emphasize what the chair has said about we're grateful for your contribution.
And just to clarify for the minutes, Chair, there is no current exposure to Elbit Systems within the table. It's a zero allocation.
Thank you for a constructive discussion. Can I ask members to note the report?
Noted.
Fabulous. Then pressing on to item 10, renewable infrastructure and data center managers. I note that this is an exempt appendix. But prior to that, is there anything that we can discuss publicly?
Chair, just to clarify that I did seek your guidance with regard to data centers and the fact that we have a new set of managers and a new asset category. in the light of the Mansion House speech by the Chancellor and the the consultation paper that came out subsequently, I sought your advice as to whether we should cancel data centres, and that was an agreement that I reached with you. So accordingly, the interviews that we've held earlier this evening were with Quimbrook.
Any public questions on that?
I don't know if you can respond to it now, but just to understand on that, is there a possibility that that data center can come back at a later date, or is it effectively can only come back with the agreement of the pool, given where things are leading? What have you had a chance to sort of engage with other boroughs or with the pool as to this asset class? Because I think personally that a lot of money is going to flow into this asset class, and one way or another, I'm sure we will end up investing into it, but there are some good opportunities at the moment.
Yes, we've sought advice and consensus from the London offices, so we do meet quite regularly, and there's a significant discussions, one of which was last week. So the consensus is that when these assets are transferred to the pool, and the 100% target has been set by 31st of March 26, the pools will take over control, and then will be responsible at that point onwards for all fund manager selection. So all implementation of and appointment of managers will be the pool's responsibility. We won't have any further discretion from that point onwards. Obviously, this is a consultation paper, but the consensus of the London officers that it would be a very brave borough at this point who would go to market for a new asset classification and new fund managers, given this is where the government has set its stall with regard to the future of the LGPS. So that was the consultation, that was the discussion I had with the chair, and we took a very regretful step to stop the data process, the data centers in its tracks. Obviously, if that asset category became an offering of the London Civ, then future consideration could be given by the committee to that. But that, where we are at the moment, that opportunity seems to have ceased.
I'd just like to support the decision that's been made there. I think that's a wise one, given the circumstances that we find ourselves in. And I think I wasn't that impressed with the presentation that we had about data centres, and doing a bit of work myself to find out more. I think that we were sensible to wait, even though we may not be making, as you say, decisions about these things in the future. But I was fully support the agreement that you made, Chair. Thank you.
Any further public questions? We will return to this item under exempt. Item 11, Pension Fund Quarterly Update, Q3 2024. Can I ask Phil and Sian to introduce public elements?
Thank you, Chair. This report and its attached appendices make up the pack for the quarter ended 30th September 2024 and includes administrative, investment and cash management performance over the quarter. Overall, the investment performance report shows that the market value of assets increased by 3 million to 1.374 million. I'd now invite Izio to go through the public performance pack.
Thank you, Sian. Thank you, Chair. Johnny Moore, Izio, Investment Advisor. I'll try to cover this fairly quickly. I know we've got a lot in the private appendix, but overall, a 1.2% positive return on an absolute basis over the quarter at the total level. Each of the underlying funds has delivered a positive return on an absolute basis, with the exception of one, which was Darwin. There's been a significant update there. Darwin management have implemented a 23% write down to net asset value there. There's a chunky update in the report, but I'll try to summarise. So The Darwin Fund in itself invests across a number of UK leisure developments, holiday parks, that type of thing. Each of these underlying assets are valued independently, and that's using a discounted cash flow model, which essentially tries to reflect trading profitability, future profitability projections, and macroeconomic factors as well. And interest rates and inflation feed quite heavily into that. So occupancy rates at the underlying assets were high both before and after the COVID pandemic. Obviously, a lot of parks were shut down during COVID, but occupancy does continue to be high now. And on the other side of things, profitability has been largely impacted by supply chain issues over the past couple of years, increasing material costs and expenses more broadly. And alongside that, we've had the general cost of living crisis, which alongside a high interest rate environment, which has meant that rents have been slightly lower than previously projected. So Darwin's decision on that was to implement that short-term haircut. We've had a lot of conversation with Darwin on this. Ultimately, the write-down isn't great in the short term. They are comfortable that these underlying assets are actually performing well and at a profit, and again with strong occupancy. The main factors underlying that discount rate are implicitly linked to the UK base rate, to the interest rate, and essentially all else remaining the same. What we're hearing from Darwin is that they expect that this short-term reduction will essentially be reversed in full when the interest rate reaches around 4%. So potentially a year, potentially a year and a half, depending what the decisions are there from Bank of England. But on that basis, the weighted average cost of capital will have been recovered completely over that period. Obviously at ISIO, we continue to monitor this. We'll continue to monitor how this develops and continue to provide updates in our reporting. Ultimately, for the Hammersmith and Fulham investment, we are locked into the fund until 2032. So any exit would be difficult. And if there was to be an attempt to exit, this would be at a significant haircut on the secondary market. And I guess secondary to that, or simultaneously, exiting now would essentially act to lock in this short-term material discount. So the best solution at present is to wait for the fund to recover, but continue to monitor and keep updating you guys there with that. Any questions on the report, Darwin?
Just on that, are you saying that the discount rate is linked to base rate rather than gilt?
Yes.
That's a bit strange.
It's I can definitely come back to you with a lot more detail on the discount rate and have a few more chats with Darwin on that. But it's the fact that a lot of the profitability assumptions based in are implicitly linked to the interest rate as well.
Yeah, I'd be interested to take it offline because it does sound a bit counterintuitive.
I hear what you say that we're locked in. I just wonder whether we should have a bit more detail on this because I don't know when it was not long after the Liz Truss debacle. I think I mentioned somewhere about would those assets get written down because they are long-term cash flows, and in theory you'd think that they'd be discounted. So I find it a little bit concerning that their board has only just now started to take into account things that have been known about. We all know, even if it's only anecdotally, how much building costs have gone up and et cetera, et cetera. I mean, I've got friends who are putting extensions on and they're 50 to 100% more than they originally expected. So I hear we can't do anything. I just wonder whether it's worth a more in-depth look. So as you say, maybe not here at this point, offline.
Yeah, I'd agree. So I think there's a detail. So as Johnny mentioned, we've been having regular conversations with obviously the size of the markdown warrants that, and we've got a more detailed note than we would usually include on page 259. So that's probably a starting point. I think it's a relatively small position for the fund, but that doesn't excuse kind of the performance. But it's definitely worth digging a bit deeper. So we can do that on your behalf. But equally, it may be worth the committee, if you think there's merit in meeting them directly and asking for more of an explanation, that can be done. I think it's probably a combination of factors in terms of interest rates going up and a bit of delay. So we heard from Aviva in terms of how their assets marked, there'll be a bit of that playing into it. But then, as Johnny mentioned, there's the development angle to it in terms of build costs and then operating profits and margins, etc. So it's probably relatively complex. But I think Johnny made the comment about some of that should recover when interest rates get to 4%. I'd say that's kind of the uncertainty, isn't it? It's if and what time period that takes time over. So that's one thing to monitor, and that's probably the point to focus on with Darwin, that damage has been done. It is illiquid. If you try to you could try and exit on the secondary market, but I'd imagine the pricing wouldn't be very good at the minute. So it's hold and see how it recovers. So it's getting clarity on how and when that could recover, I think, is the helpful bit.
But it's also a bit of complacency, when base rates get to 4, if we could all predict that, we wouldn't be sitting here.
Thank you, Chair. I think you covered all the points, Marian. It is a cause of concern. As you rightly said, it may take more than 12 months for the interest rates to get to 4%. And I think we need to monitor the Darwin investment very, very carefully going forward.
I just do remember meeting with Darwin with you, Phil, maybe a year ago, and this adjustment to the discount rate was already being discussed, or might even already have been implemented. So it does seem to have taken a while for it to have filtered through. But from what I remember from that, they were making the point that it was very much their external board based in Jersey, which had, I think I got the impression, slightly against the will of the Darwin management, insisted on changing the discount rate and the valuations. And there was never a comment that it effectively went up and down with base rate. It was like the valuation methodology was based on long-term interest rate assumptions, and those had just moved significantly over the past couple of years, and Darwin had been holding out against revaluing the assets. But in the end, when the wall broke, there's been a massive write-down. So I think there's a bit to follow up there.
To draw a line through this then, so... Oh, sorry.
So I remember that meeting, Mike. Darwin's view is very much one of, in terms of how they're operating at the moment, obviously there's a portfolio of very well-run caravan parks and leisure facilities throughout the UK, which is being added to on a regular basis, with the intention of increasing the income, the cash flow within those assets. Darwin's view is at some point in the future, there will be a buyout, and that buyout will be the subject of an offer from a much bigger firm who will be looking to take on the whole portfolio. And that's when, in terms of our investment, Hammersmith and Fulham's investment, that's when the proceeds and the attractiveness as a full valuation at that time, which is a market valuation, a sale valuation, that's when the fund basically receives its due, what it deserves for having made that initial investment and having had faith in Darwin to bring it to a point where that sale will eventually happen. When that will be, I think that there has to be. It's not Darwin going in search of a sale. It's a buyer approaching Darwin with a view to making that purchase. and that could be any time.
Which is why, in the meantime, we need to be on top of it and making sure that they're doing the things they're meant to be doing, and it's a reasonable valuation, and they're not doing an Aviva complacency thing.
It's a salutary point, and I'm sure we're all in agreement that further and monitoring and analysis would be extremely welcome.
Thank you, Chair. I have a question about a different fund, the London Civ. Something caught my eye in the report is that everyone seems to be resigning from it. Is there an issue?
Which fund was that, sorry?
I think it's London Civ. It's the CIO. It's the pool, yeah.
So the CIO has handed in her notice some months ago. So she's working a notice. It is slightly unfortunate for that particular post because it does seem to have the death knell about it. As soon as somebody is appointed, they hand in their notice.
Am I right?
Very
This
quickly.
is our third.
I think there was one guy who lasted 2 weeks. That was quite recent. I can't remember his name. Is it Thompson? Mark Thompson?
Yeah. You wouldn't remember if it was only 2 weeks.
I know that they're beavering away in terms of the appointment of the new post holder. I'm sure that interviews have been held. There's due diligence being carried out and research on the proposed candidate. We'll get to hear about it, but I'm pretty sure it's at an advanced stage. The key post is the chief exec, Dean Bowden, who a lot of people have considerable faith in, and he's moved the Civ on considerably since he started a couple of years back. As the same sentiment with more recently Andrew Myers from the Kingston and Sutton funds, and Tim Mapufu, who used to be this Hammersmith and Fulham pension fund manager. He is now an employee of the Civ, having this year passed his CFA final level 3 exams. So there's a good amount of evidence there to be have a lot of faith for the future of the Civ.
But then there were also the chief financial officer, the client's relation manager, and 2 other people who, after extended periods of leave, have decided to leave. So I'm just thinking, is there something deeper?
Yes, well, one of those is quite considerable ill health, where the individual has chosen to step aside for those particular reasons. So, but yes, I mean, in terms of the appointment process, there is a natural wastage in terms of people coming through, moving on, leaving for whatever reason. But it's just a case of I think us having faith that they will find a reasonable level at which the pool can grow and prosper in the future. We do have that faith as officers.
Yeah, I'd just add, so I think Phil's completely right. The Civ, over the course of its lifetime, has had challenges in terms of resource and recruitment. And for quite a number of years, those challenges were quite stark. I would say the last 2 or 3 years has seen a much more stable period, so much better resourced. There has been some turnover, but this and what we've seen recently outlined in this report is a spike in that. So that is concerning. It kind of raises eyebrows and warrants further investigation. But as Phil mentioned, I think the 2 new hires are really big positives, and it's a statement for the future. And I think, so there's an immediate question in terms of who replaces the CIO, etc. But there's a broader question in terms of how are Civ positioning themselves and resourcing for the future, and what the future will look like. And we'll talk a lot more about that in the private pack. So I think that's probably the thing to keep an eye on.
Any further public questions? Marvellous. We'll return to this. Item 12. Our member of the public has excluded himself. But if members agree for a motion to exclude the public and press.
Agreed.